Hey guys, welcome back. So now that we've covered a lot of the basics and fundamentals in accounting, we're going to start actually applying it to how it actually all kind of comes together. So we've covered LCRU, we've covered the understanding of T-charts, lefts and rights, making sure it balances. But obviously that's not how things actually work in the world of accounting and bookkeeping. So let's do that now. So today we're going to cover journalizing, general ledgers, and trial balances. So remember as well that if you want to follow, click on the subscribe, hit the notification so that as soon as videos get posted, you get notifications right away. All right, so let's get going. I'm going to do a general journal. So this is what a normal form looks like. And here are some transactions that we've been given. And keep in mind, this is something that you would never get. This is where you would naturally be logging it, right? You wouldn't have a piece of paper listing everything that needs to be entered in the general journal. Maybe you have some side notes or something like that. But this is where you would normally log it. And the idea of this to get it ready for your general ledger. But this kind of understands because we don't do T-charts in the real world. This is where we actually log it in. But it'll help you get things set up straight in your head so that when it comes time to do their financial reports, everything goes nice and smooth and less chance of making mistakes. Okay? So what's the very first thing that we always do? We always make sure we write the LCRU down. So let's do that now. I always put it down again. It's so easy to make mistakes, and this is always a good, quick way to quick and double check. Okay. Minus, minus, plus, minus, minus. No, plus, oops. See, that's why we write it out. And then as well, we're understanding lefts and rights. So like I mentioned before, debits versus credits. Okay, so they have to equal. Just like when we do our 5 steps. Remember, left equals right on our 5th step. So we're going to start carrying these over onto here. So the very first, actually, if we want, we could even look at the first step. So January 5th is our first date. I always like to write the date so we don't forget. And then we need to determine what are the 2 accounts. So just like when we did the 5 steps, actually, let's just write those out right now. That we do with doing T-charts. You should know these now. If you're not, please go back to previous videos. So you're going to pick the accounts. Remember, it's not just necessarily 2 accounts. It could be possibly 3. So you're going to pick the accounts. And then the next thing we're going to determine whether it goes up or it goes down. Right? And then we're going to follow which heading it falls under in LCRU. And then number 4, we're going to fill it in. And last but not least, number 5, left equals right. So the only thing that we're going to add to this is in the LCRU, understanding whether it's a debit or a credit. And it's also important to know now that we're moving into general journals for best practices. We want to do debits first when we're filling them in and credits second. And this is going to be the part will get confusing because you guys will tend to jump around. So take your time, follow the steps, and everything should work out fine. So let's, now that we're ready, so you own your own golf, operate your own golf course, journalize the following transactions that took place during the month of January 2018. So completed a job for a client worth $2,000 and paid in cash. So again, what are the 2 accounts? Just like we did, what are the 2 accounts? So cash is 1. Remember, a lot of the hints are always sometimes given right in the transaction itself. So cash is 1. And what is it when we get completed a job? Service revenue, right? Okay. Now, going back to our steps, does the accounts go up? So we completed a job and the client paid cash. So did our cash go up or did it go down? It went up. And did our service revenue, did it go up or did it go down? It went up as well. Okay. So I'm going to jump into this now as we look at it, Alcrew. So which one are these? So cash, what is cash under all in Alcrew? It's an asset, right? And what account, as we're doing here, service revenue. Alcrew, which one is it? Revenue, and it went up, so it's R. I'm gonna run out of space here, but it's okay. R. Now we're ready to go. Normally we would fill this in, but I gave you this new thing that you need to remember. Okay? Debits go first, credits second. So which one, if we see debits, which one of these are debits? Well, anything that falls on the left-hand side of Alcrew is a debit, and anything that falls on the right-hand side is credit. So we look at cash as an asset, it went up, so it would be over on the left-hand side. And is there any others? Well, service revenue goes up, so revenue went up on the credit side, so we know that actually comes second. So there's no more other debits, so we're going to do that one first. So cash goes first. The PR we're going to skip for now. We'll explain that later. And it went up by $2,000. Right, perfect. And now that we can do credit second because there are no more debits, service revenue. I'm just doing short form, so save us some space. And it's a credit, right? And the amount was $2,000. It goes up on the right-hand side. All right, so then we know left equals right. Perfect. So keep in mind now, if this is what a normal transaction would take place. So say a customer came into the shop and paid us cash. I wouldn't write this down. I'd be writing it into here where the accountant or bookkeeper would be writing it down. But if I was the owner of the business and I wanted to go back and say, what is this exactly? What's going on here? What was this revenue for and what was the cash for? We need to have a little explanation of what it is because we wouldn't have this, right? So we need to make a little comment. So completed job training. So now I know specific, what it was for. Perfect. Okay, perfect. And then we're all done. Left equals right. Awesome. So let's move on to the next one. So January 10th. And let's follow the steps. Which two accounts? Withdrew $500 cash from a business for personal expense. So withdrew, again, there's a little hint right there, right? So withdrawals is 1. And what's the other account? Well, it's cash, so it came from business, right? So the cash would have to be affected. Now, when we did the withdrawal, did it go up or it went down? It went up. And the cash, it went down, right? Because we withdrew it from the business account. So we're good. So we know withdrawals, which one it falls under. Withdrawals down here. And cash, we should know by now that this is obviously an asset. So we're good. But we need to know which one do we do first, right? We can't just start banging them out. So cash, well, let's look at withdrawals. Withdrawals, do we need to do it together? So it went up. So withdrawal could go first because it's a plus, it went up. Our cash, looking at the next account, went down, so it's over here. So it's actually a credit. So the very first one we need to put down is, right, the withdrawal. Because it's a credit, we need to do those first. And it was $500. And then the next one is cash. And it's a credit, so it goes on the right-hand side. Again, having this here is very helpful. Good. Are we done? No, we have to do the explanation, right? So the explanation, withdrew cash for personal use. Perfect. Done. I also sometimes used to mark them off so it helps don't lose track which ones I have done. January 20th. All right, so on January 20th, what happened? Paid a telephone bill worth $200. Okay, so which one accounts get affected? So we know if it's telephone bill, it's an expense. So telephone expense. And we paid for it. How do we pay for it? Well, it had to be cash. We went to the bank, had to pay for it. And we paid for it right away. So what's the next thing? Did it go up or down? Cash? Well, if we paid for something, it went down. And our expenses went up because it was a telephone bill. So that's good. Now before we're getting ready to write it out, we need to determine which one gets first, right? Because debits get done first and then credit second. So let's have a quick look. So cash is an asset, right? We know that. It went down, so that's a credit. That's no good. Telephone expense, going over here, expense went up, so it's a plus. So then it is a debit because it falls under the left-hand side. So that one gets first. Telephone, tele expense. And it was $200. And we paid with cash. And it was $200. Are we done? No, we need to have an explanation, right? So paid tele bill. All right, check. Done. Next one, what happened? So on January 21st, I received $3,000 for a catering job that will be completed next month, right? So we haven't done the job, but someone's kind of paid for us in advance. So let's write the date. January. Say January 21st. Right? Perfect. Received $3,000 for a catering job. So someone walked in and paid us. So there's cash. So cash is one for sure. We're picking the account. And for a job that would be completed. Now, if it's for a catering job that we completed, if it stopped here, this would be revenue, but it's not, right? It's completed next month. So what does that fall under? I put it over here so I run it through. So unearned revenue. We haven't completed the job yet, right? If we didn't complete the job, the customer could come back, sue us, and actually get the money back, right? And that falls under a certain category. And this is the one that always everyone gets mixed up because you hear revenue and you think it falls under revenue, but it doesn't. So it should be a huge red flag. All right. Up or down? So cash received cash, so it went up, so that's always a good thing. And our unearned revenue, did it go up or did it go down? It went up, right? So cash we know, so let's verify things. So this, because we have to do debits first, not credits. So debits, so cash going up over here, so it's an asset, so it's a debit, so that one's good. Unearned revenue, what category does that fall under? We still owe the job, right? That's the one everyone, it's a liability, right? So it went up, so it would be on the right-hand side. So that's a credit, so that's second. All right, so now we good. So first account then, because we know is cash. And it was $3,000. Okay. And the second one is unearned revenue. This is one of the ones that you gotta kind of memorize and red flag when you say has completed a job next month, that it's unearned revenue and it falls under a liability. Everyone tends to make it fall under revenue, and I get it. But it's just one of those things you got to kind of stick in your head saying, well, we haven't done the job yet, so technically we don't have the money. We haven't earned it yet, right? So we can't put it down. And it's $3,000. And it's on the credit side because, sorry, liability is on the right hand, on the credit side. Now we need an explanation, right? Because we don't know what this means. So if we have multiple businesses, so it should be customer paid for job next month. Perfect. Check. Two more. All right, so what happened? So January's 22nd. Paid for 12 months worth of rent for $1,200. Perfect. So paid, we know that. When we hear paid, what account gets affected? Cash. And months worth of rent for $1,200. What account is that? I'm running out of room here. All right. Prepaid rent, because we haven't used it yet, right? We're just at the beginning of the month. Prepaid rent. So cash, did it go up? It went down. Well, if we paid for something, it went down, right? And our prepaid rent went up. Okay, so cash we know is an asset. You remember what prepaid rent falls under? It's also an asset as well because we haven't used it yet, right? It's at the beginning of the month. So we paid for it, but we haven't used it yet. So technically we could possibly get it back depending on the contract and everything else, but we haven't used it, so it's still considered an asset. So we need to determine which goes first, debits or credits. Debits first. Which one of these is a debit? Well, cash goes down. We know from doing a couple already that it's on the minus side, so it's a credit, so that's not it. Prepaid rent is an asset. We just discussed that. So it is a plus. So it increases, so the debit goes first. So the very first account that we have to write is prepaid rent. And it was $1,200. And the other one is cash. Right, we got cash out of the bank, and it went down $1,200. And then what are we done? No, we need to do an explanation. So paid for 12 months rent. Perfect. All right, last one. So what happened? On January 31st, at the end of the month, January 31st, recognized, what's another word for recognized? Used 1 month of rent that was previously paid for. So on the 22nd, right? So we used up 1 month's rent. So what are the accounts? Well, we know prepaid rent is one because that's obviously because it's previously paid. So prepaid rent. And now because we've used it, now it becomes what? An expense, right? Rent expense. Now, did it go up or down? Rent expense, well, now became an expense, so it got added to it, so it's up. And our prepaid rent, that was originally $1,200, remember here? Well, it didn't go up, so it had to go down, right? Now we look at debits go first, credits second. So which one of these falls under the debit category? Well, let's look at this one first. Rent expense, asset expenses goes up, so that's a debit, so that's good. We could do that one first. That was previous a prepaid rent, so that's an asset. We discussed that before. Asset, so it went down, so it's on the credit side, so it's second, right? So let's do that one. So rent gets first because it falls under the debit side. Rent expense. And it was how much? They don't give it to us, so we have to figure it out. Well, basic math, 12 months divided by 1,200, meaning it's $100 per month. Right, basic math, we use up 1 month, so we used up some of that. So it's debited $100. And the other account is prepaid rent. And it's $100. That's 0. And last but not least, we need to do something. We need to have an explanation. So used 1 month's rent. Perfect. Check. All right. So that's it. So this is what you would normally have. You wouldn't have this, so you would never see this anymore, right? So when something happens, we paid. So for example, a telephone bill came in. We got to the shop early in the morning. We opened up a bill in the mailbox, and we said, "Oh, we better pay for it." So we went either online and we paid cash for it, and we didn't write this out. So this isn't where you would never have that. You would have this only, right? So then you'd log it down, and then so forth and so forth, right? So this isn't normal. This is how you would log it. You wouldn't have T-charts and everything else. This is the proper way, and then we journalize it for the entire month. All right, perfect. So now before we've done that, we need to take it to a general ledger, um, which starts making things easier because this is just for recording the transactions, right? That's all we're doing. Is the purpose of the general journal is just to record transactions. So the next thing we need to do is we need to start putting things in the report. So remember we planned and we discussed, not planned and discussed, but discussed that the next reports are stuff to start getting ready to create. The income statement, statement of owner's equity, and the balance sheet. This is where it starts here, right? Okay. So I am just going to bear with me for a sec. I'm going to take this over. And we'll take it to a blank general ledger sheet. Paste. And this one, there we go. we've corrected it so we can actually see the journal ledger, so I apologize. So now we need to start breaking into categories, and this is all we're doing is we're looking at taking all the transactions that happened and we're categorizing it so it's easier when it comes time to do our financial reports. All right. So let's look at, so we're just going to transfer this over. So these would be given to you, but if not, you would have to create general accounts. But because there are so many different accounts, we're just going to do the accounts that happened from January 5th to January 20th, right? We're not going to do all, we're just going to do these ones here because we'd have lots of room, but you'll get the idea. It's not rocket science. And then once you kind of get the gist of it. So you can go ahead and make your own if you like and continue on. But just is enough so that you can see where we're moving, pulling the information is from. All right. So I also like to do just to kind of get going here, is cash. So remember Alcrew, right? I'm just going to quickly draw this in here. Again, it's helpful. Plus, minus, 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 plus, minus, minus, plus, plus, minus. Perfect. So cash, what does cash fall under? Asset. So I'm just going to do this quickly, and it'll become more relevant later. So it's an asset, so it's plus and minus. Withdrawals, plus and minus. Service revenue is a revenue. And I'm just doing this just as a quick little reference that'll become easier later. Telephone expense. Because what we're going to do, we're going to add up all our expenses, and we're going to add up all our cash and everything else. So as you see, this general ledger would be as of January 1st, and we're going to assume the beginning balance was 600. So in December, we had a balance at the end for $60,000, and that's what all these balances are pulled from. So they'd be pulled from December 31st balance sheets. All right. So now we're looking at, okay, let's group all the cash transactions together. So let's look on this one. So on January 5th, there's one. All right. So let's pull that. So let's pull the information. So we pull the date, January 5th. And the explanation is what we're pulling. So what happened? Oh, we completed job training on that day. Completed job. And it was a debit, right, for $2,000. So it's a debit here, so we make sure we carry it over in the right spot. $2,000. Perfect. All right. Now, as we go through, we need to adjust the balance. And the reason we're doing this is so that we can track and double check things so we're not making mistakes as we go. So if it's a debit, it gets added to the 60,000. This is why I do it, so it doesn't get confusing, right? So debit in this case is adding, right? Because if it's a revenue, it'd be the credits would be adding. So that's why I put these here just as a quick reference. And you'll get better at it. So we just add the 2,000 to the 60,000. So what do you get? 62,000, right? Because we're adding it. Perfect. And that's it. So the other thing that we have to do, we need, actually, I won't do that next. We'll do this one next. So let's move on. Is there any cash transactions? So there's this one here. So there's a cash. And what was that for? Oh, withdrawal for personal use. So on January 10th, we use for personal expenses. So you can see all we're doing is carrying it all over. And it was for $500, right? Cash, $500. And it was on the credit side, right? It makes it a little bit easier. So it goes over here, $500. Now what is the balance? Right? So because it's a credit, it's a minus. So we're subtracting it now. In this case, so you'd have $61,500. Right? Perfect. One, two. Let's see if there's any cash. Cash. Oh, here's one. Right. So on January 20th, there was one. So I ran out of space. So just right underneath, not a big deal. Then what was that for? Paid telephone bill. So the reason was a telephone bill. Telephone bill. And how much was it for? $200. And was it a debit or credit? It was a credit. So it would be over on this side. And since credits in this case are a subtract, we subtract it from the total. And you would end up with 61,300. Perfect. And if we continued on, like if we had more, but for now we're only doing because of January 5th to 21st, because we can go on and on and on. We could do, there's another one for cash that would fall under debit for $3,000 and so forth. But we're done because we're only doing to the 20th. All right, just so that you get the idea. So withdrawals, let's see if there's any withdrawals in these transactions here. Cash, service revenue. Oh, there's one withdrawal. Perfect. All right, so when did that happen? January 10th. Okay, and what was it for? Personal expense. Expense. And how much was it? $500. So withdraw, so it was on the debit side, so we need to carry it over from there. So $500. Right. Now, does it get added or subtract from it? Just because it's on the debit is not necessarily the case. We need to look at the account and see what side the plus or the minus falls on. If it's on the plus side, we add it to it, right? So we need to make the balance change. We need to adjust it right away. Perfect. Let's see if there's any more. January 10th, that was it. January 20th, nope. Excellent. So let's move along. That one's done. Let's look at service revenue. Which ones do we have? We got, oh, here's one, January 5th. There's a service revenue for $2,000 on credit. So on January 5th, can't get it in there. Service revenue. Is that right? No. We want the explanation, not the account. Right? So what is it? Completed a job. So that's what we want in there. Don't get confused. Completed job. And how much was it for? $2,000, and it's on the credit side. So it's over here. Okay. Now we need to, do we add or subtract it? Because automatically, this is where people mess up. You think it's on the right, so you subtract. Well, no, we need to look at the account. Well, revenue, it increased, so we add it to it, right? And think of it. If service revenue, if you got a job, your balance would increase, right? So 32,000 is our new balance. Perfect. Is there any more? Service revenue. Nope, because we're stopping at January 20th, so there's no more. All right. What's next? Expenses, telephone expense. Withdrawals, cash. We did this one here. So there was a telephone expense here. If we had multiple telephone expenses, we'd keep adding it if we were going beyond the January 20th, but there's only the one today. So on January 20th, so down here on the bottom, space January 20th, and what was the explanation? Paid telephone bill. right? Paid bill. I don't need to write that it's a telephone bill because it's a telephone expense. We already know that in the title, right? And how much was the telephone bill? $200. The telephone bill was on the debit side, right here. So, debit side, we're just transferring it over. Now we need to know, do we add it or subtract it from the $8,000? Well, we look at our accounts and expenses increase on the left-hand side or in the debit side. So we would add to it. So 8,200 is our balance for telephone expenses. Okay? And that's pretty much it. The only last thing we need to do as a cross-check is we look at what this PR stands for. And it's page reference or previous reference. So we need to know where we got this information from. Again, it's a double check, right? Where did we get this information from? If I'm looking at this and say I'm the owner and the bookkeeper, and I'm looking at this personal expense, I'm like, well, where did this happen? Like, where did you make this transaction from? Well, I can go back to my general journal and say, oh, where on these? Because keep in mind, you could have multiple pages of these, and it can get you have multiple transactions of a business, right? You can get up to hundreds of transactions in a day. So you need to know where you pulled it from. And again, it's just a cross check to make sure there's no mistakes, right? And it's easy tracking. So let's go here. So this is really easy because we pulled all this information. We pulled it from page 3. Okay, and that reference could be anything. Could page two, wherever you got it from. All right. And on the general journal, we have where did it get recorded, and that's what we need to look at. So let's look at the cash one. So we'll just walk through them all at once. We'll do the general journal first. So where did this one get recorded? Well, it got recorded on account number 101. So we would write 101. Perfect. And then you could go here. And where did this come from? Well, all of these actually came from page 3, right? So we could actually fill those out right now because we know they all came from page 3. You can just expedite this a little faster. But if you had multiple pages, I mean, this is where you do one at a time and make it more accurate. But we're just trying to be efficient. Page 3. Perfect. So now all we need to do is fill in for the general journal which appropriate account it was. The service revenue, which is the service revenue, that is account number 301. So this is 301. Perfect. Withdrawal, what account did that get put under? Account number 102. Cash, where did this one get counted? Well, cash is 101. Telephone expense, 401. I mean, once you start going, you can, cash was 101 because we just did that. Cash again, 101. Unearned revenue. Oh, we didn't do that. Remember, we're only logging. We only did the January 20th, right? So we don't have an unearned revenue account right now, but we would. So we don't need to worry about this one here. But it would be 101 if it was logged. But we only did up to telephone bill is all we did. All right. And that's it. I hope that makes things a little clearer. Again, it's taking your time, getting in the little helpful hints. Having LQ written down never hurts. It's always a quick reference. And until you become really comfortable, I'd highly recommend it because this is where people get challenged. They mess up on the balances. This is where they kind of get mixed up. Does it go on the left or does it go on the right? Debit and credit. And if it's because on the credit, I mean, this is usually easy because you're pulling it from here. But you can see if you make the mistake here, it's going to transfer over to here. And this is where it can kind of get confusing. All right. All right. So that's it. And I think our next video, we're going to go into doing a trial balance. All right, good luck. Balance sheet would look like. So we would continue on. So we just did the general journal, we just did the general ledger, and now we would be pulling all these totals from that general ledger that we just did. Now this is a different company because it makes it a little bit easier. Just pulled all the totals because we only did a few dates in the last one. These are, I would say, if we had about 10 different accounts, and it's just easier to pull it from that. Okay, so before we start getting into doing a trial balance, there are a few things that we need to just put a little heading here so we can remember what we're doing. If I spell it right, trial balance. It's because things are it gets a little different because they want us to do things in a certain order. All right. So first thing, just like anything, let's write accrue down because we know that. And the reason we're doing this is just a check before we start doing our financial reports. This is why we're doing a trial balance. It's kind of exactly what it sounds. It's a trial balance before we actually do a balance sheet or an income statement. This will catch any errors, okay? So this is the acronym that accrue that we are familiar with. When it comes to trial balances, the new one that we need to remember are the same accounts. They're just in the different order, and it's so that when we go to do the financial reports, it's a lot easier. So anything make it easier, less chance of making mistakes, right? Becomes more efficient. So the new acronym is all lost cats will return eventually. And you probably just ask yourself, what did he just say? So the easy way, remember we remembered accrue. So this is accrue, just with the words changed around a little bit, letters reversed around a little bit. This one, how we remember this one, and it's kind of crazy, but all, it seems to stick in your head, all lost cats. If anyone has a cat, you probably had this happen because they do always return. So all lost cats will return eventually. All right. So that helps us do that. And it'll come, I'll explain that more, but this is the new acronym that you need to remember. All lost cats will return eventually. Okay. So what's the very first thing we should probably be doing is before we get going is I want to label these. Remember from accrue, because we're going to have to put them in this new order. So it helps if understanding which one accounts that these fall under. So let's do that now. Cash falls under which of these headings? If you didn't get asset right, shame on you. You should know that now. Capital, it's capital. Travel expense, expense. Prepaid rent, that's a tricky one, right? That's an asset. Accounts payable, well, if we pay something, is that good or bad? It's bad if we're paying, so if it's not an asset, it's a liability. Right? And this account, accounts receivable, well, receiving money is a good thing, so that's an asset. Asset. Withdrawals is withdrawals. Vehicles, that falls under, we talked about it, PPE, or the heading would be assets, because it's an asset. Mortgage payable, so if we have to pay somebody something, we have to pay mortgage into a mortgage company or to the bank, that would be a liability. And then service revenue is revenue. All right, we are almost good to go. So now we've labeled them. So all we have to do is transfer all this information now onto our sheet. All right. So I think actually what I'm going to do as well, I'm just going to put these in the right order so we don't get confused whether it's a debit or credit. Remember, oops, you can never be shamed for writing too many helpful tips down until you become really good at it. Plus, minus. Okay, so we're good. All right, so we're doing a report. So just like when we learned financial reports earlier, we need what? The company name, right? So in this case, Colleen's Tennis Shop. Perfect. And what's next? Well, the type of report is it's a trial balance. And last but not least is the date. So a trial balance is one of those reports that is date specific. It's not necessarily month ending or year ending. So in this case, it's December 31st, 2018 in this example. Perfect. Okay. Um, so just as a reminder, I'm just going to put here. So this is not month ending or year ending. Okay. So let's put some headings in here so we know what should go here. Any guesses? Right. Debit and credit. Right. Left equals right. Remember that? All right. So maybe basically now, just because it's a balance sheet, if you remember when we did a balance sheet, well, a trial balance, same thing. We're basically confirming that left equals right, debits equal credits, before we create the actual official reports, right? Okay. So because we have to use these new ones in the order in which we're going to label them, that's what we need to do first. So let's start looking through. So we know assets are first, so which one of these are assets? Cash is an asset, and so let's write that one down. So cash. Now is it a debit or a credit? Well, in this case it's positive, so it'd be on the left-hand side, so it's a debit, and it's a debit of $10,000. Right? We know it's on the left-hand side because of here, right? It's a plus. All right. Now, I just like to mark them off so I don't miss any. Is there any more assets? Prepaid rent. There's an asset. So yeah. So here's the kicker. They should be in an order of liquidity. So prepaid rent. Can we get that back as fast? Depending on the contract, so maybe not. So before we do that one, let's look at what's next. Accounts receivable. That's an asset. Could we get that back? Yeah, that could get back pretty quick, right? We could take them to the court. Vehicles, could we liquidate that one first pretty fast? Yeah, I mean, back and forth. I mean, they both could be done relatively quickly. But let's use accounts receivable. And it was for $1,500. And it's a plus sign, so it's on the left hand, so it's a debit. Okay, check. So which one's next? Well, we still have the prepaid rent or the vehicle, so we'll do vehicles next because you could go out and sell this for whatever it's worth right away, probably. You might take a loss on it, but you might be able to sell that right away. So this could be vehicle, to be more specific. I mean, it could be PPE as well, depending on how it's been categorized. But in this case, we'll just use vehicle, and it's 22,000, and it's on the debit side because it's a plus. Check, so that's done. Is there any more assets? Oh yeah, the prepaid rent. Prepaid rent. And that is $2,000. Check. There's no more assets, right? Perfect. What's the next one we need to do? Liabilities, lost cats. We need to look at the liabilities. So let's go through L's, L's, L's. So we have one here, accounts payable and mortgage payable. So which one would probably get first? Well, most of your accounts payable would get paid first. And it's a liability. So it goes on, if it's up, on the right-hand side, so it goes on the credit. So it goes on this side. And how much was it? $10,200. $10,200. Check. Got it. Any more liabilities? Mortgage payable. So that could be from a mortgage company. Possibly. Could be from the bank. Mortgage payable. And it was for $5,000, and it goes on the right-hand side. Why? Because liability is on the right-hand side, right? It's a plus. It's $5,000. Perfect. All right. Any more liabilities? Nope. Perfect. So the next one we have to do is capital, or CATS. Capital, right here. There it is, $13,000. So go on the debit side or the credit side? Well, let's look here. It goes on the credit side because it's a plus. So capital. And it goes on the right-hand side because it's a credit, right? We know that. Here it goes right here. It's a plus. So it's $13,000. Perfect. Any more capitals? Nope. So write that one off. Check. Nope. And that's it. So next one, according to our new list, W. So withdrawals. There's one right here. So withdraw. And it was for $1,200. So it goes on the right-hand side or left-hand side. So we need to determine it. Let's go back to our chart. Oh, on our left-hand side. So it goes on the debit side because it's a positive, right? So $1,200. So it would be on this side. You see the benefit of having it written down. If you get in the steps, you're always checking. And then once you get better at it, you can become faster at it. Check. No more withdrawals. Perfect. Revenues or return. No R's. R's are service revenue. Perfect. Service revenue. And we need to go, just go on the debit or the credit side. Well, let's go back and look at our new acronym. R is on the right-hand side, right? This is a biggie one. This is where people get mistakes. So it falls right on the credit side. So $9,500. Check, right? Because it went on the right-hand side, the credit side, because it went up. And what's the last one here? Expenses. E, eventually. So we need to do expenses. So what was it? A travel expense? Expense. Does it go on the right-hand side? Because we need to know, is it debit or credit? We tend to always want to think that goes on debit because we always think positive on this side, negative, and that's not the case. Right? We go back to here and look. E's eventually revenue, or sorry, expense, travel expense. So it goes on the left-hand side, it goes on the debit side, and it's $1,000. Right? Yep. Perfect. Excellent. Done. Any more accounts? Nope. Got them all. Perfect. So now we need to do like a balance. We need to make sure left equals right. So we're going to total these puppies up and see what we get. And doing my quick math that I already calculated out. $3,700. This one is $3,700 as well, $3,770. And yay, left equals right. So when we verify it, we just double underline that we verified that they match. And that's it. And that's a trial balance. So a few key things take away from doing a trial balance. This is a biggie, right? The new acronym, all lost cats will return eventually. That's the new the new acronym that you need to remember. So the reason we do this is that if you look at, because next step now would be making those financial reports that we learned, these three would go on. What's the first statement that we need to do? An income statement. These would be, these all of them next, right? Go on the statement of owner's equity. And then the last one goes on the balance sheet. And that's why we do them in that new order. It just makes it easier when we're transferring the information over. Less chance of making errors. And that's really what it comes down to, is doing things in a certain order so that less chance of making mistakes, because it could be a costly mistake. All right, guys, good luck. And if you have any questions, feel free to leave a message in the comment before or like the video. Thanks.